If you've got money to spare, you've got a relatively long time horizon, you can deal with ups and downs, like you have the stomach for downs as well as, ups. Well, then overwhelmingly, like almost 100% of economists will say index funds is your best bet. But then there are some, limitations, right? One is, are you saving for the short term? Like, are you saving because you need a new car, like in the next 6 months or year or something? Well, then an index fund might not be the way to go, right? Because it might go down in the short term.
No.
The other thing is, like, if you don't have the stomach for a down market and you're going to go and like take your money back out again as soon as it dips, well, then you're almost certain to lose money off of the index fund, right? So you shouldn't be doing that. But if you've got a long enough time horizon, like if you're young, you're saving for retirement, or you're mid-career, you've got like a stable retirement plan, you're saving for like some extra fun in old age, well, you're good, right? If it's for the short term, you should probably do something else.
I think what's important to define here as well is what an economist means when they say the best. Because in your book, you made that distinction, and it isn't probably what people think. What I would consider the best would be the best performing, whereas you're not saying that, are you?
Right. So there might be other outcomes, other investment vehicles that will give you or a person higher payoff, right? The problem is that before the fact, you can't tell what they are. Like after the fact, you can say, well, here are the funds that really appreciated over the relevant time frame. And you can say later on that what you should have done maybe was to invest in like whatever.
All in NVIDIA.
Yeah, exactly, right? The point is that ahead of time, you can't know what those options are. It's just like the lottery, right? After the fact, you know that the winning numbers were 18, 27, 73, whatever, right? After the fact, you can say what you should have done like last week. But last week, you couldn't have said what those numbers were going to be. And the same thing is true with investments, right? So after the fact, you will find that there were other funds that did better. But ahead of time, the best thing you can do is to invest in an index fund, which distributes risk in the right sort of way, and that gives you as good an outcome as you could possibly hope for.
Is this on the margin thing that you refer to? Like, what does this term mean?
So thinking on the margin is like one of the things that sort of characterize the economic way of thinking. And it's this idea that you should think in terms of the last unit. What are the benefits and costs of the last unit? So an illustration of that is like your last pound, whatever, in your pocket. What should you do with it? Well, if you're starving now and you haven't eaten all day, right, spending that money on food is probably a good idea, right? You're not going to be able to function if you don't eat something today. So if that's your last dollar, then the wise thing to do is to eat. But if you're already like comfortably off, you've paid the most important bills, you're fine, the investing that pound in more food is not going to do you any good. It might actually cause you harm. That pound is something you might invest in one of these index funds. And so the point here is that when you decide what to do with a quid, you can't just think about like a quid in general or the average quid or whatever. You have to think about the last one. And that's thinking on the margin. It's an incredibly powerful way of thinking about the decisions that you're making. It's not totally intuitive, which is why we teach it in economics departments. But once you've sort of acquired the way of reflecting, it becomes second nature and is really very helpful.
So you're saying if you only had a pound and it was your last ever pound and you had to invest it, what would you do? And you would put it into an index fund because you know that the downside risk is not total. It's like it's not going to go to zero, but there's a good chance of it going long term. Whereas if you only had a pound, you wouldn't go and put it into Tesla because you think, well, there's risk there that it might underperform. Is that what you're saying?
Yeah, so that sounds right. And it depends on like where you are, right? There are other exceptions. Like if you are in fact a professional investor, or if you have inside information, right? It would probably be illegal to trade on that information, but you could, right? It might
Must
be.
be got camera. Have you got some of that?
We'll talk about it later.
I'm not telling you guys what to do, but right. So conditions change a little bit. So what's the best thing to do on the margin changes for me from one day to another, and it changes across people, right? So what might be best for you need not be best for me. I think the happiness idea, or the idea of happiness, is a good illustration of this as well. So when it comes to money and happiness, contrary to what people say, that money can't buy happiness, and whatever economists who've studied this thing for literally 100 years now have always been agreed that you can buy happiness for money. if you're poor. So if you don't have a whole lot of money, getting more cash is going to be good for your happiness level. There's never been any question about that. There's some question about what happens like when you become rich. So what's the marginal effect on your happiness of the last quid when you're affluent or rich? And there's been some disagreement. Right now, it seems as though happiness keeps increasing. So even if you're spectacularly rich, getting another quid does make you, like on the average, a little happier than you were before. Now, people look at this research and they say to themselves, or they say to each other, we should always try to be richer. We should all try to make more money. And that's a mistake. Why is it a mistake? Well, it's a mistake because like the marginal effect of that quid goes down, right? The more money you make, the smaller the effect of that unit of money on your happiness, right? It may be that when you're rich, you should be spending it on something totally different. Like the last quid might be better spent on, I don't know, a day in the park with your kids, or, you know, a gift for your mother, if you're fortunate enough to have a mother still alive, and so on, right? Thinking on the margin is critical for knowing like when to quit. When should you stop making money? It's a weird thing to hear an economist say, maybe, right? But there is a point at which you should stop making money and spend your cash on other things.
This was a clip from our episode with Eric Agner. What? It was.
Okay, look, this was a clip from our episode with Eric Agner. You can watch the full episode right here. He's an economist, he's amazing, he tells you all about how to get rich and fix the world and stuff like that.
Just take it by
That's
George.
it, that's the clip. We want to laugh at you because it's funny. Eric Agner.